I do want to ask you, sir, what you consider will be the top challenges that India Inc. faces as it converges to Ind AS or converges to IFRS. I think, over 660 listed companies in this country have a net worth of 500 crore rupees or more. Even if I were to take banking, NBFC and insurance companies out of that list, we do have a sizable list of companies that will need to adopt Ind AS in a very short period from now. What do you expect will be the challenges as India Inc. goes about this process?
I will say, to my mind, there are 3 or 4 major challenges. Number one challenge is the tax system in the country, basically. You see, if you remember, Manka, in the last attempt that we had in 10-11 to make it effective 1/4/2011, one of the biggest issues was with regard to the tax structure of the country. There are certain countries where the tax is applied on consolidated financial statements. In our case, this is applied on the standalone financial statements. And the moment you talk of the fair valuation, one of the fears in the mind of the industry has been that when you fair value something, if you have a gain, the assessing officer is going to tax it, and when there is going to be a fair value loss, probably the assessing officer is going to say, no, it is not the incurred loss as at the present moment, so I am going to disallow this particular part. Rather than mitigating this particular hardship, I think the CBDT has been coming up with the idea of having tax computation standards. One of the very basic purposes of introducing the IFRS equivalent standards in the country was that the cost of duplication of the effort should be minimized. Now, if you are going to have tax computation standards which are based upon the cost concept, in that particular case, what is going to happen? To some extent, there has to be a duplication of the records. There is no doubt about it. And which will mean that there is some kind of a cost to be incurred in maintenance of that record. Again, I am coming over to certain indirect tax challenges also. Now, as I said to begin with, when I was talking about the revenue recognition, at that particular point of time when I talked of Ind AS 115, if you say that certain sale component is in the nature of the finance charge, and I am going to show it as a finance charge, will the excise people agree to that? Excise people are still going to say, no, it's a part of my sale price. So that's another change in the indirect taxes. The second challenge to my mind will be with regard to the IT systems. And this IT systems will have to undergo a change, and this will involve some kind of a cost, there is no doubt about it. I think some of the bigger industries which have already raised money from abroad are seized of the matter. They have already implemented those systems. But this cost, when it comes to the banks and insurance companies, I think it will have a huge amount. That's the way I look at it.
Okay.
But the systemic changes will have to be brought in so far as this particular issue is concerned. Another challenge which to my mind will be there are certain carve-outs that we are going to bring. And those carve-outs will be absolutely minimal, but keeping in view the requirement of the Indian industry and certain other factors where probably some of the options may not be misused by anyone. So we have opted for those minimal carve-outs.
So what are those carve-outs, if you could share with us, please?
You see, one of the carve-outs is that if you look at Ind AS 1 itself, internationally when you define a current liability, what you say is that if you have taken a loan, if you have borrowed certain amounts from, say, you have taken some loan from a bank, and there were various covenants, and if you breach any of the covenants, and if the lender has got a right to recall the loan, irrespective of the fact whether they have recalled the loan or not, in that particular case, it will be considered to be a current liability. But what we have said is that if we do this in Indian circumstances, if you really ask me, what kind of current liabilities people will have to show in the books of accounts, you know it, and where the current ratios will go, I don't know. So what we have said is that wherever there are material breaches of the covenants, but that irregularity has been set right before the adoption of the accounts, in that case it may not be treated as a current liability. And as a consequence of that, we will have to really even have a carve out in the Ind AS 10 also, which deals with the events after the reporting date. So we will have certain carve-outs. Now this carve-out is in the favor of the industry, if you really ask me.
Yes.
Then otherwise, what in the case of the leases, what was going to happen is that if any agreement contained a clause of escalation, it said that you consider all those escalations and then treat it as based upon the straight line, just write off those escalations also along with the lease rentals. What we have said is that if the escalation is linked with the inflation, in that case you need not straight line it. So to that extent there will be a relief for the Indian corporates for that matter. And certain options we have done away with, very frankly, like in investment property, the option was that you could fair value it and still take it to the revenue account. We said nothing doing. If you allow this option, in that case people will take something to the revenue, declare the dividend, distribute the dividend out of unearned income, which is not realized so far. So we have tried to avoid those kind of situations.
Okay. So I do want to ask you for a clarification. These Indian accounting standards or Ind AS and this roadmap to IFRS, will it apply to standalone financial accounts or consolidated accounts, sir?
To us, it is very clear that it is going to apply to both. You see, one of the demands of the industry was that you apply it only on the consolidated financial statements.
Right.
But then both the Accounting Standard Board, the Institute and the NACAS were of the opinion that the moment you make it only based upon the consolidated, you apply it only to the consolidated, the confusion is going to be far more than what it is today. Because from standalone converting it, consolidating and then converting it to the IFRS will not serve the purpose. In whichever country that is happening, there probably the taxation structure is different, and there the taxation structure is on the consolidated financial statements. In India, the taxation structure is based upon the standalone financial statements, so accordingly we must apply it to the standalone financial statements and then move on to the consolidated, and both these statements must comply with the Ind AS requirements.
Okay, my final question then, sir, has to do not with IFRS or Ind AS, but some of the other changes that NACAS is currently attending to, which is changes to Indian GAAP to bring them closer to where Ind AS is currently or will be in a few weeks from now. If you could very briefly outline to us what some of those key changes will be.
You see, I can only tell you that one of the changes which will be coming by way of Ind AS even will be componentization approach in the property, plant and equipment, which is not there. Today, if you have a machinery, you have a machinery in hand. But if there is a significant component thereof, you don't have the values thereof and you don't depreciate those separately. Now, effective, once Ind AS is implemented, it's going to be there. But if you look at the Schedule 3 today and Schedule 2 today, of the Companies Act, Schedule 2 has already required this approach to be followed. But then the Institute went to the Ministry of Corporate Affairs and the chambers also went to the Ministry of Corporate Affairs, and they have agreed that this componentization approach will be effective only 1/4/2015. Now, we will definitely have to bring our AS10 today, property, plant and equipment, in line there with. Today we don't have the componentization approach, so that's what we are going to have.
Okay.
Similarly, the revenue recognition will have to undergo a change, and definitely to some extent, and we'll have to see how do we bring the real estate transactions under which head these are going to be taxed, and how do we deal with the construction contracts if you are going to implement 115 later on. So to my mind, there are certain standards which have to be brought in line with, and today whatever AS1 today we have, that is with regard to the disclosure of the accounting policies, that's too primitive. I think we'll have to bring it in line with the Ind AS 1 for that matter, presentation of financial statements. So I think this is what is going to happen.
All right, Mr. Chopra, I suspect that this is the first of many conversations that we will have with you through the course of 2015. Our next date with you is once the Ind AS are notified by the ministry, and then we'll dive in deep on the impact on financial reporting by India Inc. Thank you for your time today, and thank you very much for watching. But before I go, a hat tip to Chris Parsons.
Chris Parsons heads the India practice of UK's leading law firm Herbert Smith. As he finishes 30 years at his firm, he is celebrating it by walking for charity. Chris has raised $280,000 in the last 6 months and is now walking for more.
I've been coming to India now for about 10 years, and I was very keen to do something charitable coming here to India. And so 2 years ago I decided to walk for the Lumba Foundation that supports widows and their children through my friendship with Raj Lumba. And in fact this year marks my 30 years at my firm. And so I decided to round that up, 30 years, 30 marathons, 30 days. And I thought it would be wonderful to walk down the west coast of India from Mumbai, starting at the gateway of India, down through Goa, Mangalore, and then across the Western Ghats through Mysore, arriving in Bangalore, I hope, on the 8th of February.